So, after months or even years of procrastination, you finally decided to get financially free by investing in the stock market. But when you started looking into it, one of those investing pundits came up with a whole lot of complex terms like dividend investing, value investing, passive investing, growth investing, active investing, DE, ROE, ROI, and so on. And there was only one thing that he did not address, and that was how to actually take that first step. This is a common question many people find themselves entangled in before actually starting to invest in the stock market. But today, we've put together a simple step-by-step guide for beginners, which is going to help you guys make your money in the stock market. Welcome to 5-Star Finance. No doubt that investing in stocks is one of the best ways to make some passive income to live freely by the late years of your life. And in this video, we're going to walk you guys through the complications of the stock market. And by the end of this video, you guys will be able to start investing in the stock market. So sit back and pay attention because you don't want to miss out. Before further delays, let's jump right in. Well, first of all, you need to go through a stockbroker. You need to make an account with a stockbroker, and basically, a stockbroker is someone who works for you in the stock market. When you want to buy some shares of a company, there has to be someone who is selling those shares and someone who is buying them. And a stockbroker will work as the bridge between you and the shares. You tell a broker that you want to buy some shares, and the stockbroker will take that order and execute it for you. So this is the way you go ahead and purchase those shares for you. The stockbroker will make the transaction for you, but they don't do it for free, and that's how they earn their bread and butter. They will charge what we call the brokerage fees for making the transaction for you. So you need to factor that in when you're thinking about investing. For example, let us suppose that you're choosing a broker to buy some shares of stock. Now the broker can cost you $25 for an investment of $10,000, and investments over $10,000, they will cost you 0.31% of that investment. This is a hypothetical example, but you may find scenarios that are going to be close to this example. Now, once you get into a company by buying some shares of a listed investment company, you may not have to pay the brokerage fees again and again if you're planning to buy some more shares. The company you're investing in may contact you and offer if you want to buy X amount of shares. If this is the case, the brokerage fees can be waived away. This is the way to directly purchase shares from the company. But to start investing, you always need to pay brokerage fees. Okay, so that was the first step. You need to find a stockbroker for yourself, which brings us to the second step, which is important. You need to budget out how much money you've got to invest in buying some stocks. Usually, you might want to go and talk to some people who are already investing successfully in the stock market. Just take a whole lot of notes and learn about how much you're willing to invest personally. Many beginners make a paramount mistake of investing all of their money in the stock market. They've got nothing to fall back on. You always need to have some safe amount in your bank account because there might be some risk involved in some of your investments as a beginner. When you're investing, you need to have a budget that's got room for all of your expenses, whether it's medical fund or education fund or utility bills. It can be anything, but you cannot neglect these factors. You've always got to factor these things in. Have a really good thought process behind your finances. Let us just say that you've got $5,000 to invest in the stock market. You might not want to put all of that $5,000 in the stock market right at that moment. What you can do is you can always hold on to a little bit of that cash and wait for a really good opportunity to invest and make significant profits. You might put $3,000 in some companies, and then you find out that there's a cheap stock available that has bright prospects in the future. You put your remaining $2,000 in that stock, along with another $1,000 which you saved up from your paycheck. After some time, you realize that due to this decision, you've made incredible returns, and now you're well and truly on your pathway to financial independence. Whereas on the contrary, you might have invested all of that $5,000 and you would have missed a vital opportunity to make some profits. So that was step number 2 about budgeting how much you actually want to put in buying those stocks. That brings us to our third step. Have a clear strategy. You cannot step into the stock market with no plan whatsoever. You need to know about what companies you are trying to invest in and how much money do you think you can set aside to invest in the stock market. For example, when you invest in the S&P 500, which includes 500 of the largest companies, you should understand the business model behind that company. Suppose you're investing in Apple, which is one of the leading companies in the tech sector. You need to know their underlying business model as to how much they are making through the iPhone, how much they are making through Mac, and so on. Sometimes when you invest in these companies, they're taking your money and investing it in some other company. You need to know what's going around. Simple as that. Your strategy should be clear, whether you're looking for stocks that are paying out huge dividends or stocks from growth companies that are striving to provide bright long-term prospects. Or you might want to look at a combination of dividend-paying companies and growth companies. It completely depends on your investing strategy. So that was the third step, which is really about what your strategy is going to be. The fourth step is perhaps the most important one. Once you've made an account and made a clear-cut strategy, now you want to make a watch list and research or analyze stocks. This is the time when you start figuring out what companies you actually want to invest in. That is where your comfort zone or your circle of competence steps in. A circle of competence is simply the group of companies or a niche that you think you're the most familiar with. You want to make a list of these companies and analyze them to see if they're going to bring some long-term profits for you. Once you've got a few companies in your target, you might have heard about them from someone or you might have researched them on your own. Just add them to your watch list. For that, just go on your brokerage page, find the tab that would be about watch lists, and then type in the company acronym or ticker symbol, and then you can start to track that company. You can always see what's happening with that company and what's new in the air, and you can further enhance your research. So you might want to think about a few profitable companies that lie inside your circle of competence. Put them on your watch list and start tracking them. You need to research and figure out if the company is growing or its value is going down. Have a look at their business model. Or you can also look at their dividend-paying history and try to guess about the growth. Once you get some quality companies on your watch list, the next step is to simply add to your investments or reinvest dividends. This step will allow you to compound your profits, and eventually you guys will learn how the snowball effect works. Investing is all about growth over time. You can also make a trade with your stocks to make some money. Now, when a company has paid out a dividend to you, you can either use that money to hang out with your friends and spend all of that money in quick succession, or you can always use that money to buy some additional shares of that company and simply grow over time. You're supercharging your long-term profits by reinvesting those dividends, which is a great way to accumulate wealth. So how it works is that when you reinvest your dividends to buy some more shares, your dividend will grow over time, which lets you buy even more shares, and that's how the snowball effect gets rolling. By the time the snowball reaches the downside of a cliff, it has turned into an enormous one. It is important to notice that you need to research the stocks in detail before you hope to make some profits. For that purpose, we've provided a free ebook for beginners in the link below, which explains the 6 stock categories that are each different to analyze. Make sure you give those categories a look, because knowledge is what separates the great from the average. Check out the video we handpicked for you, and we'll see you in the next one.